Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this video, we are going to take a look at the retirement income planning calculator that you can find in the Service Canada website under the Canada Pension Plan Benefits section. This is a great little calculator that many people aren't aware is available. So we're going to walk you through the data entry. So where to find the calculator first, look at the data entry, the outputs from the calculator, then how you can use those outputs for your own retirement income planning. So you find this video helpful. Now, if you're new to our channel, make sure you hit subscribe so you don't miss future content that we're posting on a regular basis. As well, if you go to the show notes, there's links to various free resources on retirement income planning. As well, you can find out how you can get your own complimentary retirement income planning forecast. Okay, let's take a look at the calculator. Okay, so what I've done is I've logged into my Service Canada account. I'm not going to go through how that login process works. You'll have to work through that step on your own. So I'm in my account, and if I go down to these tabs here, there's a tab on the right-hand side that says Canada Pension Plan, Old Age Security. So click on that. And then once you get to that page, just go on the right-hand column here. The first thing you want to do before we go to the calculator is just reconfirm your benefits. So I'm going to click on the tab Payments. Let's go to that right now. And when I get to the Payments tab, I'm going to scroll through, just go down to this, and it says Contributions, CPP contributions, and then the estimated monthly CPP benefits. And this is a specific estimate for myself. So you can see that the benefits are listed. So if I retired right away at age 65 and at age 70. So what you'll want to do is just write down this information because you're going to need these numbers when you actually use the calculator. Okay, let's leave this page. Okay, I'm back to the page saying Canada Pension Plan Old Age Security. Again, here's this tab on the right-hand side. Keep scrolling down this tab, and you're going to eventually come to the Canadian Retirement Income Calculator. That's what you want. Just click on that tab, and it's going to take you to the website for you to make use of the calculator. Now, it's going to walk you through some information that you need to pull together before you start working on your calculations. So, you need to go through and take a look at various pieces of information. I'll just quickly give you a basic idea. Current value of RSP accounts, potentially TFSA accounts, non-registered accounts. If you've got a pension plan, what the estimates are at your retirement date from your employer-sponsored pension plans. And then, of course, your Canada Pension Plan estimates. So go through this page here, what I need before you start the process of entering the data. It's got some related links that might be helpful for you as you go through the information. Okay, so you've completed the gathering of all the information that they've outlined here. Let's hit continue. And now we're at the calculator. So we're going to walk through the main steps of these calculators. Of course, when were you born? What is your gender? Right, we'll start going through each of those calculations. So before we go any further on the calculator and the data entry, it's important we talk about what the calculator is and what it isn't. So what it is a good basic application to give you specifically an idea of how much retirement income you could potentially generate through your retirement years. What it isn't is a detailed calculator that takes into account various issues that could be, for example, income splitting with your spouse. So if you've got a partner, really your income planning should be done as a couple, not as an individual. So you want to be able to model the impact of income splitting, pension income splitting on the model. You also want to model the impact of life expectancies that might be different between each of you, and the survivor needs that might be important to talk about for the surviving partner. It doesn't take a look at legacy or estate planning. It doesn't do a good job on delineating the differences of how you get investment income outside of TFSAs and RSPs, so income through interest, dividends, and capital gains. It doesn't do a good job of looking at sequence of return risk. Markets are variable, life is a variable, this is a linear return model. So to get more information about more detailed retirement income planning, make sure you go to the show notes for this video where we talk about our complementary retirement analysis, and there you'll get a glimpse of what a more robust retirement analysis would do for you. Okay, let's go back to the data entry. Okay, so we'll begin doing the data entry. It's going to ask you for information on your birth month, your birth year, your gender, and your current annual income from all sources before tax. So I use the number $80,000 just for this illustration per year, and it gives you some basic information about averages for people, making $80,000 pre-tax before they retire, what their range is when they retire. I didn't use their range. They put in $62,000 per year in the calculator, but I went in and I reset the number to $80,000 per year in the calculator. Now, a couple of things about income for these calculations. So before you retire, you've got probably not as much opportunity for income splitting. So you're making your income, you have larger source deductions pre-retirement than after retirement. So often what happens is you actually have to make more money pre-tax before you retire for a certain level of after-tax income lifestyle than when you retire. Because when you retire, not only will you not have the same source deductions, but you'll be able to income split with your partner. So we usually see people dropping 1 to 2 tax brackets, plus they don't have the outsourced deductions. So the amount of pre-tax income they require to keep them at the same after-tax income they had before they retired is less. And that's generally the experience for many people. Now, it's obviously not the experience for people retiring without a partner, without the ability to income split. But if you have a partner, it's a very powerful benefit. So for now, we just kept the income at $80,000, which was the pre-tax income that we wanted to have in this example. So based on your current age and gender, your life expectancy is age 85. Would you like to use age 85 as your estimate? So again, for a male my age, that would be life expectancy. Then you just kind of take a look at that and go, well, do I want to use average life expectancy? If there's longevity in my family, maybe I go in and use something different. So I'm going to say no. And then it's going to say, please enter the age you'd like to use. And so I'm going to increase it a little bit. So I'm going to increase it to age 90 in my particular example. Okay, so that's the first page of the data entry. Let's go to the next page. Okay, now we're going to enter the data for Canada Pension Plan benefits. So it asks whether you're part of Canada Pension Plan or Quebec Pension Plan. I'm part of Canada Pension Plan. Do you have a CPP statement of contributions and benefit? I don't have that, but I did go into the page that shows the estimate of my benefits, so I wrote that down. So I'm going to say, no, I don't have a statement. If you have a statement, you could say yes, but it might be easier just to go to the Canada Pension Plan section to where the estimates are and just use those numbers. So the average for monthly income, it gives you the average. Do you want to use that average number? I said no, let's use a different value. Please select the monthly amount of CPP you expect to receive at age 65. So again, you go into this drop-down box. The maximum right now is $1,364 to $1,300. When I went into the calculations, I'm at $1,328, so I'll use $1,364 in this example. Okay, the next thing is it talks about the fact that you can, receive benefits of various dates. When do you expect to receive your benefits? So in my calculations, I'm going to use age 70. So I'm going to defer receiving the benefit until then. So we'll do that. And then do you plan on working after you start receiving your CPP? And I'll just say for the purpose of this calculator, no. Okay, now this page is asking questions on employer-sponsored pension plans. So if you're part of a pension plan at work, then this would apply. So are you a member of the plan? Yes, no. Okay, I've said yes in this example. What type of pension plan is it? So it gives you a number of options: defined benefit, defined contribution, pooled registered pension plan, deferred profit sharing plan, group RSP. So defined benefit plan, if you're not familiar with the basic terms, that's a formula plan. Years of service times a certain benefit rate times the average of your best 5 years, or the average career earnings. It's really driven by the formula. If you're not sure, make sure you go back to your benefits department to confirm that. All these other plans are really a function of how much is in the plan right now, how much is being contributed by you and your employer each year, and what kind of return do you expect to get on that plan. So if it's a defined benefit plan, you just put in the estimate of the income on that plan, and when do you want to receive that pension, so the date or age, and then is the pension plan indexed? Is there a cost of living that's contractually part of that plan? Increasingly, that's becoming very uncommon, but that could be the case for your plan. Now, for the purpose of this illustration, I'm going to check off defined contribution plan. So for the defined contribution plan, we're assuming that there's $100,000 in the plan right now, that I'll begin to take income from the plan at age 65. Remember, I used $80,000 pre-tax income, so this is a 5% matching plan. So $4,000 will be contributed by my employer, $4,000 by myself. We assumed a 5% return on the portfolio. The return that you use really is a function of how you invest money typically. So if you're very conservative, you would use something lower. At the time we were producing the video, we thought that inflation probably will settle out at 2.5% to 3%. So if you use 3% as a cautious investor buying GICs, high yield savings accounts, T-bills, that's probably reasonable. If you're a balanced portfolio investor maintaining a cash position, let's say 10%, fixed income bond position of 30%, and the balance of the portfolio is 60% high quality equities, then a 5% return is reasonable. That's probably the low end of the return expectation. So if you take a look at the forecasted income between age 65 and age 90, we're showing an income of $5,514 per year. And so that income payment will go up over the years at the rate of inflation used in the model, and then it'll be fully depleted by your age 90. So if you look at the financial summary here, I'll show it to you in a second. It's integrated into the planning. Now, we also assume that there'd be some defined benefit pension benefits. So if you go into the defined benefit option, you can add that, which I did. I assumed that I would get $2,000 per year beginning at age 65 with no indexing on the pension plan. So for many of you, you might have these small little benefits you've accrued over the years. That's very common for people. So this gives you a spot to enter that little benefit amount, whether it's defined contribution, group RSPs, or defined benefit plan. Now, I said the plan was not indexed, so interesting. What the planning model does, it says, well, an annual inflation rate of 2.2% is being used in this model. So they've decreased the purchasing power in this pension plan. So if I go to the assumptions here in employer pension plan, it says the income between the defined benefit plan of 2 and the money defined contribution starts at $75.14 per year pre-tax, and gradually by age 90 it has purchasing power of $66.50 because it's losing ground over the years. So the calculator takes into account the purchasing power of money. Okay, let's look at retirement savings. So under retirement savings, what we did is we said, yes, I've got an RSP. I've got $500,000 in that RSP account. I'm adding $5,000 per year until age 65. And I will take income from age 65 to age 90 from that plan. Again, we used a 5% return on the portfolio. And then it asks questions about, do you have any other savings, such as tax-free savings accounts, that you plan on using for your retirement? I said yes, so it brought up another data entry box. I put $150,000 of TFSA value, and on average, how much are you planning to contribute? For now, I said nothing to this plan. And at what point are you going to start receiving money from your savings? Well, I said at age 65. Now, this is again the weakness of these particular calculators. So obviously, when we do our retirement planning for our clients, there's a lot of work that goes into deaccumulation strategies, i.e., when do I take CPP benefits? Do I use my non-registered portfolio, my RSPs first? Do I use my TFSAs last? So the calculator doesn't really allow you to do that level of dialed-in planning. It's got some very basic assumptions it allows us to use. So for now, we're just saying at what age you want to start using it, at age 65, and what age do you stop using it at age 90. And again, we used a 5% return. So combined, your total retirement savings from past and future contributions are estimated to be $673,000 expressed in today's dollars. This would provide an annual income of $33,459 in retirement expressed in today's dollars. Now, let's just take a look at the assumptions that they're using for this model. Again, that's income over and above the government benefits that you'll be receiving. So let's just take a look at the assumption tag just to see what they're using as the main assumptions. So the main assumptions in this model, again, they're using an inflation rate of 2.2%. We used an investment return of 5%. Contributions are made at the end of each year. You continue to contribute up to age 65. Your retirement savings are split evenly throughout your retirement in today's dollars. We convert your savings into a stream of fixed income based on a standard annuity formula, investment rate of return of 4% after you convert your savings to income. You have no more savings by age 90. Okay, so they did reduce the overall return on the income payments. So again, it's a very rough calculation, and it gets back to what I just said. It doesn't allow you to customize the planning around these income streams, but it gives you a basic starting point as to whether you're tracking in the direction of replacing your overall retirement income. Now, the other thing that we did is we added old age security. So if I go to the old age security tab, do you expect to be living in Canada when you retire? Yes. Will you have lived in Canada for at least 40 years? We said yes, so that would allow us to get maximum CPP benefit. At what age do you plan to receive your OAS pension? We left it at the default at age 65. Of course, you can defer taking it. If you defer to age 70, there's a 36% increase in benefits. If you defer CPP to age 70, there's a 42% increase in benefits. Okay, so it gives us a nice summary of all those different benefit areas. Now, there's a tab here that says Other Income. Will you have other income? I said yes. What type of income will it be? Now, I said employment income. But again, it gives you these options, right? If you have rental property coming in, maybe you can continue business income, annuities that you're going to purchase, pensions from other countries, other pensions, lump sums from inheritances, or maybe real estate sales. So it allows you to enter some of that information as well. I said employment income, $25,000 per year. At what age would you start receiving your estimated income? I said at age 65. And when would you stop receiving that part-time income? I said age 69. Okay, we've completed the data entry, the key fields, and you look at our goal again in the red here. That's $80,000 per year in pre-tax income. And then you can see that all our different income sources are listed here. So we'll go through them together. So we've got old age security benefits, $85,556. That's the brown here. And we have other income benefits in the green, $25,000 per year of part-time employment income showing up at age 65. We've got retirement savings of $33,459 starting at age 65. That's this sort of, I guess, pinkish color here, purplish color. So that's ongoing all the way through to age 90. We then have employer-sponsored pension plan income, $75,414. That's right here. That's a combination of the defined contribution pension plan and the defined benefit pension plan of $2,000 per year. Now, again, with the investments in pensions, old age security, CPP, and then all the income sources from TFSA, RSP accounts, as an example, are all inflation adjusted in terms of maintaining the purchasing power. So if you look at retirement savings, $33,459 annually starting at age 65 to age 90. There'll be no capital left at age 90, and those payments will be increased incrementally every year at that just over 2% inflation rate. There's that employer pension plan again. The purchasing power goes from $75,414 to $66,050 because the defined benefit pension plan is not indexed. And then you've got Canada Pension Plan at $23,243, and that's this particular benefit amount right here. It starts at age 70 and goes all the way through the analysis. So there is a shortfall between the goal of $80,000 and where we're landing in terms of all the different income sources for this retirement model, but pretty close. When I put the first data entry piece in this calculator, it said anyone earning $80,000 on average, they defaulted me to about $62,000. So we're above the 62, just below the 80. And so we can go back and do some modeling and say, well, what if I added some more money to my portfolio? Are there other ways I could generate some cash flow? So again, keep in mind that, in a couple situation, this does look different because $80,000 pre-tax, particularly with income splitting with a partner, probably goes a lot further. So we're paying more tax than probably what is necessary if we were in a couple situation. Now, let's leave this, and I'm just going to look at the summary report. So it gives you a little summary report here. You got each year's sources of income, Canada Pension Plan, employer-sponsored income. We've got retirement savings income. We've got other income from employment, old age security, and then the total estimated income from all sources. So there's a shortfall. It's not a huge shortfall in terms of cash flows, roughly between $5,000 to $7,000 per year in shortfall. So it's a great summary of these numbers. Now, if we go to the overall summary page, let's go there right now. It's going to give us a great sort of baseline for all the data that we've put into this plan here. So again, if you go through each, it just shows you all the data pieces as a summary. You can take a look at that at your leisure. And then once we go through all that information, it actually allows you to download all the information. And once you've done that, then you can go to print report, and we can take a look at the overall report that it generates for us. It gives us all the data, all that summary information, and you can download that to your computer. Anyway, I hope that you found that helpful. It's a great little calculator. It's a good starting point so that if you want to get some estimates in terms of your income, start there. But it has some deficiencies in terms of true modeling around income splitting, deaccumulation strategies, the impact of variable return from markets. If you want that kind of analysis done, which I'd recommend, make sure you go to our show notes. You can get back to our website where you can find out how you can get a complimentary plan, as well as the links to free resources on retirement income planning. Anyway, wishing you all the best in your retirement and overall wealth planning journey. You take care. Bye-bye.